Hey everyone, thanks for joining me. In today's video, I'm going to be talking about 3 Canadian dividend stocks that I'm buying in September of 2023. Now, I'm just going to jump right into it. As you can see on the screen, the first stock that I'm buying in September of 2023 is more TD Bank stock. So, TD Bank is a Canadian bank, also operates a pretty big division in the US. We're going to be going through some more of their presentations and stock information in a second. But just to lay the ground a bit, it's currently paying about a 4.6% dividend yield, trading at a trailing PE between 10 and 11. Stock's down about 5% year to date. You can see with that financial or banking crisis with the regional banks early in the year, the company dipped from about 95 bucks down to 80, high 70s, and it never really fully recovered back. They've posted some earnings since then that we'll go through. But overall, as we look at this company over a very long period of time, they've done a great job of providing shareholder returns, both through dividend growth as well as capital appreciation. And anytime that there's been a bit of a stall in the stock price growth, they've been able to take advantage of that, buy back shares, drive faster growth than the market's expected in the short term, and it's usually resulted in a jump forward, as you can kind of see over the long-term trend. Looking at their business a little bit here, you can see they have a large part of their business in retail banking. So about 40% of the Canadian side, 30% on the US side. So that's about 70% of the business. They do own a chunk of Charles Schwab. That's because of the merger with TD Ameritrade. So they always get a nice dividend payment from Charles Schwab every quarter that goes straight to their bottom line, which is good to own some of that equity in that brokerage. Wealth management's a business that they've been building steadily over time, and they do a bit of wholesale banking as well. So unlike some other banks in Canada, like Scotiabank, for instance, that has some Latin American exposure, RBC has a lot of global exposure. TD's really focused on Canada and the US markets, which are very developed, very economically driven markets. So really good exposure from a risk standpoint to be playing in for TD. And I really like how they do have a lot of their profits stemming from the retail and commercial sides of the business. Just to get a sense of their footprint here, you can kind of see in Canada, their branches are coast to coast, but primarily more Ontario, which is just typical because of where the population lies. In the US, they really focus on Northeast and down the east side of the US. They don't really operate in many of the other states on the west side of the country. They've talked about the Carolinas, Florida being growth destinations in terms of population growth and other things in those regions. So that's why they've really focused on growing their presence there. So I just wanted to share their footprint. This is their earnings over the last 5-6 years. So you can see how they've gone from about 10.5 billion in net earnings to 17 billion in net earnings. And just as a reminder, the market cap for this company is about 150 billion dollars here. So trading at 17 billion dollar net earnings last year. And you can really see that it's been coming from a lot of different areas. Lots of their business has been stable here. Slight growth in the Canadian banking, which is the light green pillar on the bottom. But what's really grown the most, especially in the last couple of years, has been U.S. retail banking has gotten significantly bigger from 2020, 2021 to 2022. So that's an area of focus that I think they're going to continue to try to grow the overall business in, just because they're so well penetrated in the Canadian market already. So it's only so much more market share they can grow, and return on investment of getting that additional user in Canada or customer in Canada may be higher than expanding into the US with that. So excited to see how far the business can push into the US to really drive that net earnings growth over time. And then just as they look at their value creation model, how they plan to return value to shareholders. So right now, this is kind of their financial targets. They want to pay out 40 to 50% of their net earnings as dividends. I really like that ratio. It gives me a good chunk of capital back, but it still enables half of the earnings of the company to be reinvested in either share buybacks if there's no better opportunities, but also acquisitions, digital growth, other opportunities in the financial sector, which I do think there's a lot long term. EPS growth over the medium term, 7 to 10%. It's really hard to get double-digit EPS growth from companies that are trading at 10 times PEs or less than 10 times PEs with oligopolies and really strong market positions. So I just think the banking sector as a whole, specifically the Canadian banking sector, is just fundamentally undervalued. And that's why I am looking to invest more in TD, build up my position in TD even more than I already have. If we're actually able to get 7 to 10% EPS growth on a 10 times PE, that means I'm buying in at a 9 times 2024 PE, an 8 times 2025, a 6.5 to 7 times 2026. So that just continues to compound over time, which should increase my yield on cost over time as they increase their dividend every year, and so on and so forth. So I just think that the banks are great buys, great value, in my opinion. I know they're cyclical, but overall, the economy has done well and persevered, and I think these banks are big enough that they can weather the storm. So I do like to see that they're expecting to grow 7 to 10%, and I do like to see that they're still expecting to maintain that 40 to 50% dividend ratio, because naturally, as EPS grows 7 to 10%, the dividend will follow if they want to keep that whole. Just looking at their last quarter's earnings. So last quarter, they reported adjusted earnings of about $2 a share. They had some revenue growth, but some headwinds because of provisions for credit loss on the bottom line. Provision for credit loss, or PCLs is what they're called a lot, is not necessarily realized. It's just forecasting how many loans may not end up getting paid back because of the macro economy. But overall, not to go through this line by line, I think it was a decent report, especially given the macro economy and what the stock's been trading at. One of the things I really liked in the report is they actually announced that they will be buying back about 90 million shares, which is about 5% of the company. So even if they don't grow revenues and profits too much over the next year, their EPS should still be going up because of the cancellation of 90,000 shares. This has really been a point of contention for TD, just because they took out a lot of money when they were going to buy First Horizon. The deal didn't go through, so they have all this money on their balance sheet. People thought they'd be looking for another big acquisition potentially or whatnot, but it looks like they're just going to be returning it back to shareholders through buybacks, which I personally don't mind if they don't feel like they have better options. And then lastly here on TD, expected to do just over $8 of EPS this year, about $8.36 in 2024. So the company at this valuation is expected to do about 10 times future earnings, which once again, I think if I look long term and just didn't tell you what the company was, if I said there's a company that's trading 10 times earnings that's expected to grow their dividend, or their EPS rather, 7 to 10% a year over the next 5 years, I think that's a pretty attractive setup for a company. So that's why I'm buying more TD Bank. TD is one of my biggest positions. I've been nibbling on it a bit more in August, but looking to continue that into September. Stock number 2 that I'm buying more of in September of 2023 is Canadian Apartment Property REIT. So CAP-REIT is a real estate company that owns residential real estate in Canada. They have about 50% of their business in Ontario, primarily in the GTA, and the rest of it is spread out across Canada. Currently trading at about $8.3 billion. The company does just over $400 million of funds from operations. So we're trading at about 20 times earnings here, and we're getting a 3% dividend yield from the company. Looking at their second quarter results here, which is pretty in line with what their run rates have been, they're expected to do, or they have been doing, about 60 cents a quarter in funds from operations. So $2.40 on an annualized basis. Looking at their share price, it's literally about just over 20 times funds from operation multiple. What I really like to see is they actually started buying back shares pretty significantly. 3.8% of their float canceled, just because of the disconnect between their net asset value, which is the amount their real estate's worth, that's measured by a third party, minus the debt the company has, would equate to $57 a share. But you can buy it on the open market right now for $49. So you're getting about 16-17% discount on the true value of the real estate that the trust holds. Now, I think they actually bought that at lower valuations than the stock is today, so they even created more value for shareholders from when they got it on. But you can see here, FFO, just over $100 million. So annualize that, just over $400 million. The company's worth about 800 or 8.2, $8.3 billion. Pretty conservative FFO payout ratio, so lots of capital remaining to buy new properties, pay down debt, buy back shares, depending on what is going to provide the most attractive returns for the shareholder. When looking at their capital strategy here, so you can see here they are really focused on optimizing their portfolio and returning value to shareholders. The two pillars at the top is all about selling and monetizing assets that aren't core to the business. So property dispositions and excess land dispositions that aren't really generating income for the shareholder, get the capital for the shareholder up front and put it to work is kind of what they're looking at doing. And when they get capital from these two avenues, the three things they're looking at doing is the buyback, building or acquiring new apartments. That's been a big thing. They're trying to mix their business more towards newer apartments and more luxury than it currently is. And then lastly, debt repayment with interest rates going up as high as they have. That's also an attractive allocation of capital too. So between the buyback, debt repayments, and focusing on new apartments, I think they have the right priorities for capital allocation. And from non-core property dispositions and especially just excess land dispositions where they're not yielding any immediate return, I think that makes sense to fund these strategic drivers through those avenues. So here is just them summarizing their NCIB or their buyback program. So year to date, they spent over $300 million, weighted average purchase price $46. So at those levels, they're getting about a 25% discount on the true value of each unit. So this was a great allocation of shareholder capital. They bought back about 7.5% or 7.5 million units, which is about 5% of the overall company here. So this was a great display on how when stock prices go down for long-term shareholders, it's actually opportunities to accelerate long-term value creation if the management team is positioned well from a balance sheet standpoint and has the right ideas on what they can do. So I was a big fan of this plan that they put in place, and it really drove a lot more confidence in the management team, which I love to see for a company that I'm holding on to for the long term. And then lastly here, lots of REITs, especially like office REITs, retail to a lesser extent, people are concerned about mortgages and if they can refinance. You know, I'm not really concerned about that for a residential REIT. These are properties and assets that have super high occupancy rates, and I don't foresee banks not wanting to have these on their loan books. I think it's more of a concern for office properties where just the sentiment in that space has gotten so negative that lots of banks don't want to be tied to them or want that on their books. But I honestly don't think it's too big of a deal for a residential REIT rather. But even at that, you can kind of see they don't have any huge debt maturing in any given year. And hopefully by the end of the decade, the interest rates have kind of gone down, or at least the sentiment around real estate would normalize a bit. But you can kind of see here, I don't really foresee any significant risk or cash call issue with regards to being able to manage their debt from a year-to-year basis, which is good to see. Okay, so that was the second stock that I am buying. The third Canadian dividend stock that I am buying is actually an ETF. It is ticker XIC. This is just a TSX Composite ETF. It's essentially a ETF that just follows the entire TSX. Looking at this company, delivered about 5% a year over the last 5 years before the 2 to 3% dividend it also pays. So about 7-8%, which is what you generally would expect from the market. Looking at some more information on XIC, you can kind of see here, if you invested 20 years ago or 25 years ago, $10,000, you'd be in a pretty good spot now. They own the entire Canadian stock market. One of the things I really like about this ETF, which I'll show you in a second, it's an extremely low cost ETF, actually the lowest cost one that I own, I think. And it's just a good diversifying element to have in my Canadian stock portfolio. I have a lot of real estate, I have a lot of financials, I have a lot of royalty funds, stuff like that. There's tons of elements of the Canadian market that I don't touch, whether that's energy in any great way and some other more niche segments of the market. But I like having this ETF because I really am able to touch the entire Canadian economy, and I don't really have to think of where I'm allocating the buys in my portfolio 1 week to the other or 1 year to the other. This is just knowing that I am covered for my Canadian positions across all of these sectors that you see here, especially some of the ones I'm under invested in Canada here: industrials, materials, IT, energy. All of those are ones that I don't really have a big presence in my portfolio from a Canadian standpoint. In terms of dividend yield, you see here trailing 12 months yield is about 3.1%. They expect current yield to be about 3.25%. So it is still a Canadian dividend stock. It's just a super diversified play. I don't think I'm going to get overly rich on this one, but I think I should be able to get decent, in line with market returns, get a 3% dividend yield back, not have to worry about missing out on any specific element of the Canadian economy if I build this up into a big enough position. Looking at the fees, I really like how the management fees here is just about 5 to 6 basis points. That was a big plus for me. And then as I look at all holdings, just going through some of these companies that I don't own, but I'd love to get some exposure to, like Bell, energy companies, Waste Connections, Nutrien, and mining. Mining's a industry I don't own anything in, so getting some exposure there as well. Intact, Wheaton Precious Metals, another mining company. Dollarama, some more retail. I don't really own any Canadian retail. I just own it in the indirectly through REITs, I guess you can say. So lots of companies here that just sleep well at night knowing that I have a more diversified Canadian portfolio that's still paying me a nice 3.2% return on my money from a dividend standpoint. So there you have it. Those are the 3 Canadian dividend stocks that I am adding to my portfolio and buying more of throughout September 2023. If you made it to the very end of the video, thank you so much. Not too many people make it to the end, so be sure to let me know in the comments. Also, be sure to give this video a big thumbs up. It really does help with the YouTube algorithm. Appreciate you guys staying till the end. I'll see you guys in the next one. Thanks.